just give you a quick introduction to the topic we are gonna go through tonight, which is using volume in order to identify and manage actually supply and demand areas. This is something which is really interesting because in terms of price action, supply and demand zones is something that is really helpful most of the times in order to, first of all, determine what market structure is. So if we have market which is ranging or chopping around, or it is going towards uh, having a directionality, so it is building, establishing a trend, and also in order to determine where the likely to be points of pullback of a directional move can get up to. This is, of course, something which typically it is expressed all in terms of price actions, price action moves. Today, we will be talking about using those concepts and putting that in combination with volume. It will be, of course, the uh, initial application of volume for what applies to these concepts. But going on with our webinars, and as we go through more advanced concepts in terms of other volume tools such as volume profile or TPO charts or order flow, mostly order flow, which is going to be the topic of the entire month of October. So apparently we will be spending a lot of time together. Today we're just gonna start looking at these kind of things in order to start identifying what supply and demand areas are, what do they mean, both in terms of price behavior and also in terms of significance. And then for this visual representation, we will also introduce a different type of chart, which is the range-based chart. Maybe some of you are mostly used to time-based time frames like 5 minutes, 30 minutes daily charts. Range chart, so they give us some help in terms of identifying price structures and price behavior. And in this case, supply and demand areas combining with the underlying volume, of course, makes even more sense. I'm gonna share my screen so you can only see. Okay, sorry, I can just find the proper button. Okay, here we are. It should be visible. What are we looking at the moment? S&P 500 of today. We are trading 44,526. So we had a kind of ranging day. Not that much in terms of volatility, which is actually the perfect condition in order to, I have the perfect example given by the market in order to talk about what I am planning to do, to talk about. So, first of all, as I was introducing the topic, this is what the range chart looks like. Let me just zoom it the right way. Okay. Specifically, this is a 30 range chart. What does it mean? It means that every single candle that we can see here in the chart is not formed based on the time as the main parameter. It is rather based on price volatility. That means I have a bar closing in order to start the new bar every time price goes through a range of at least 30 ticks. That means from the high and the low, the range from the high and the low of the candle, it always will be 30 ticks. That means that comes, of course, with two implications. The first one is every single bar will have the very same length in terms of volatility, of course. This could be a downside compared to normal time-based bars, because of course, if we quickly use, just for reference, if we take a look at the 5-minute chart, that's the very same chart we were looking at last time. Here it is. According to, since the main parameter is time, we can see that wherever within a specific and always constant range of minutes, in this case 5 minutes, we had in some bars price going faster, okay, so giving us more ticks in terms of length of the bar. We don't have this information available from the range in the range bars because of course they are completely unrelated from time, because of course market transact with different speed, okay, according to the different times of the day. For example, in the morning S&P 500 could complete a range of 30 ticks in terms of price move maybe in 30-40 minutes. At 3:30, as soon as the paid session opens, we can have the same range of price completed in just 5 minutes. So time between a bar and a following bar, it is completely variable here using range bars, but the fixed parameter will be the length of every single bar. Second implication, bars, of course, have to be, if we use a range-based chart, closing of each bars has to be right at the very top of the candle, either at the very bottom of the candle. So we can actually have shadows, but only in one side of the candle. Because, of course, in order for candle to respect the range excursion we just set up here in the platform and open the new bar, of course, once the range is completed, that means the bar closes and it opens the new bar. So the closing of the candle has, of course, to be at the very high or at the very low of the candle which has just closed. So ideally, that's another important information, because wherever we have a shadow, that's the opposite extreme as opposed to the extreme the candle has closed towards. So if, for example, we have this candle here closing as an up bar, we have this rejection wick here at the top, at the bottom, that means that that's a further confirmation in terms of price action that price has been rejecting what the low of the candle was before actually reversing and closing all the way up. And of course, the bar itself still shows a 30 range. a 30 ticks range. Why this price representation is quite important? For two reasons, basically. Apart from this quick and very simple evidence of where areas where price was rejected given by the wicks of the various candles, the most important information is that it helps very well to distinguish between areas where price have been chopping around, have ranged a lot for more or less time, and phases where actually volatility and directionality picked up and a directional move has been started. This is very helpful because those two phases are actually the two macro phases the market tends to behave like. More specifically, when we have range phases like this one, we can tell, just looking at price action, of course, market was balancing. Market was in a perfect state of balance between buyers and sellers. That means that they were interacting each other. Lots of buyers were buying, lots of sellers were selling, and they were buying and selling about roughly with the same power and with the same commitment. Therefore, market is in a perfect state of balance and it doesn't go anywhere, basically. Fair enough. Okay. Uh, this situation, of course, lets us think at the first very important concept we will be talk more deeply from next time on, which is acceptance. Price was strongly accepted here because both buyers and sellers, actually lots of buyers and lots of sellers were interacting, were willing to transact on that level. Of course, that means battle. They were fighting with each other. For this reason, there isn't a real dominance of any one of those two categories of market participants. This situation drastically changes as soon as we get out of this phase. So we don't have price ranging anymore. We have price starting to build a directional move in one side, going away from the previous area where we had price ranging. What does this mean? Basically, one of the two categories of participants have overcome the other side of market participant. In this case, here within the area of congestion, of range, buyers and sellers were roughly balancing each other. Eventually, sellers have won. So they were able to drive the market away from this area, building a very nice move to the downside here. Okay, cool. Of course, this is just the result of a previous auction, a previous fight, which has been taking place in right here over the acceptance area. But that's a result of something which, of course, has been preparing for some time, for some bar, for a range, and eventually produced an outcome, which is that. As a rule of thumb, we can consider that as a victory actually of sellers. That means that the overall result of whatever happens over that range, over that where they were fighting with each other, sellers have won. So supply was the dominant force right here and produced this outcome. Now, maybe you already knew about something like this in terms of identifying supply and demand areas, looking at minute chart, but you will definitely, I guess, agree with me that in a range-based chart, it is much easier to spot. Like, for example, let's look at a different example in the other side. Same thing here, market ranging here, so no dominance at all. Strong break to the upside. So from here on, buyers have won. That classifies this area as demand area, an area where demand has actually demand, that means buyers have overcome sellers, supply, and therefore that's the point where this move has originated, right? Cool. And by my point of view, looking at that from a range chart perspective is much cleaner rather than sometimes 30 minutes bars or volume-based bars, because normally ranges are very visible, as well as as well as this swing breaking the previous range, because normally where we have breakouts to the high or to the low of a previous range bars also allow us to determine the strength of the swing, because normally, since bars are based on a range of n ticks, right, we can see if bars overlap each other, of course we will have a weaker break. If bars on the other side, they don't overlap too much each other, like in this case, as you can see, we had the bar here, next bar forms here, price goes all the way up straight away without even retracing back on any level previously traded by the previous bar. On the next bar, a tiny retracement before continuing. So we can also determine by just looking at price action left by every single bar how strong the breakout was. And of course, this is the first filter in order to identify a, a better demand area as opposed to a worse, maybe a weaker demand or supply area. Okay, this applies mostly to price action, but of course we are talking about volume in this webinar. So volume plays a crucial role in identifying these dynamics. Why? Because first of all, using volume, we can read inside this dynamic. So we have using this platform, using these tools, we have many information is actually available. For example, can you see the color code of these bars? Every single bar is different by the previous one, or where we have a move to the upside, we tend to have a green bar, but the shading of the green is quite different bar by bar, as well as the shading for red bars. This is a very nice tool from Volsys platform because it gives us actually the strength of the volume trading in that direction. We will go deeper into that as we will be talking about delta in a few webinars. Before talking about delta, of course, we need to define and determine what delta actually means, but just to explain that straight away in a very simple and hopefully easy to understand way, delta is the strength, okay, is how much force we put into a dynamic. So basically, we can have lots of volume trading, but if we have 500 buyers as opposed to 500 sellers, volume will be strong. Of course, we will be 1,000 transactions, but who is winning? Actually, they are almost even, right? In terms of intentions. Delta gives us a very nice framework of that. Gives us a very nice picture of how much they are actually pushing strong or weak in one direction. And in this case, as you can see, the color is getting much darker, more intense as we get away from the area. That means, as I was explaining last week, that first of all, volume is actually sustaining the move, the breakout, which is crucial in order to determine and establish that this is a proper demand area. How many times can you see breakouts of previous ranges, but they turn out to be fakes? I guess so many times in the S&P 500, for example, even more in the Nasdaq, but just normally in these cases, we can't consider those areas as supply and demand because there was no winner yet. There was just an attempt to break the upper side or the lower side of a range or a previous range, but actually with lots of effort, without result. So the low effort versus result we were talking about last week. In some other cases, no effort at all and no result either. When, like in this case, delta, so the power sustaining the move, of course, it gives us a nice green light in order to consider this level, this breakout as genuine, and therefore the range area where the breakout has originated from as a proper demand area or a supply area, according to the direction it was broken towards. Okay, this is in terms of delta, but actually we can also have a very nice information given by volume, by total volume. I just need to get another chart in order to explain this concept. Uh, let's find a similar example. Okay, for example, here. First of all, how does indicator work? This is one of the indicators available in the Volsys platform, which is called Vol Analyzer. Uh, Basically, it is a suite of indicators explaining, actually showing different information regarding volume, regarding delta, and with the aim of actually making the volume analysis the overall more simple. There are lots of way of use that. In fact, I will be using that a lot during the next webinar we will be having. But so far, let's go step by step. How can we use that tool to filter out the better and the worse supply on demand areas to be taken into consideration? We just need to see whether basically either if the breakout is sustained by volume, by total volume, but not just the volume of a simple bar, the volume referring as an information to the single bar as we were looking at last time using the volume histogram below time-based charts. This tool shows us the total volume involved over more bars. So just for reference, this swing to the upside, over the swing to the upside, 106,000 transactions, lots transacted, took place. How is that calculated? The goal, it is, of course, combining all of the bars, making the relevant swing. So if this is the relevant swing, making a new high, breaking this range here, we need to, of course, consider the total volume involved in this bar plus the volume involved in this bar, and so on. But it will be too hard whilst trading, while making our analysis and making our trading decision to calculate the volume of every single bar and summing them up together. So the software in this case will do the job for us. Using a zigzag parameter, which just calculates the length of the swing based on a minimum range of reversal from the high or from the low, the temporary high or low. It would detect what the current swing is. Can you see this white line here? It shows where actually the swing, according to zigzag, according of course to the setting that I've put, will just determine the end of a swing to the upside and turns it out into a swing to the downside. And by detecting that, we'll just calculate all of the volume involved in every single bar making the swing and giving us this information. This is an information actually which is valid in different versions, like for example volume, delta, as delta expressed in terms of volume, delta expressed in terms of ticks or trades, there is a slight but important difference between those two values, because I can ideally trade 10 lots at a time, and in this case I would affect the delta volume. Delta intended as the difference between the contracts I am trading with. But if I trade 10 lots with just one click, so I make one trade of 10 lots altogether, that would count as one single trade. So if I make this trade with 10 lots entering the market altogether, the delta trade will be affected as a +1, but the delta volume will be +10. Okay, so there is a slight difference. And then another information is the extension of the swing, of course. These informations are also available as visual representation here in the lower part of the screen. There are different ways we can use that, but ideally here we can see that the edge of each rectangle would show how much volume, total volume, was involved in that swing. As you can see, the rectangle perfectly matches the beginning and the end of the swing. The height actually here shows of the rectangle how much volume we had trading, and the fill inside the rectangle can actually show the delta. In this case, it is white here in my representation because I didn't set it yet. For today, we are just focusing on volume. But also this information is important. So if we want to also see how strong, apart from volume, total volume, how strong this push to the outside was in terms of relative power, we can also decide to have delta shown here. And we can quickly do that. So I can also show you the feature of the platform. The indicator is the gold swing, this one. As you can see, there are many features and parameters we can set up differently. So for example, the zigzag settings here will base on 10 ticks of reversal. So if that means that wherever I have a swing to the upside, every time it retraces back 10 ticks +1 from the very high or from the absolute high or the absolute low of the swing, that will just turn out the previous swing to the upside in a swing to the downside. So if we adjust that, making a with a weaker or stronger parameter, of course we can have the zigzag following the price more or less closely to the price. But in this case, what do I need to do in order to have delta? Is just setting the color here. So positive delta, we just choose an ordinary green and an ordinary red for the negative delta. And as you can see, the delta color code shows inside the indicator. The shading actually of the delta, so whether it's intense green or light green, or of course red, shows how intense the push of that swing is. So in this case, we have another fantastic evidence of this being a very good demand area so far, because price broke to the upside with a nice amount of volume, also compared to the previous swing. We can see that volume is actually increasing on a new top, on a new high that market is making. So definitely there is participation. Definitely we can tell the move is sustained by volume. And delta, of course, is sustaining the move as well, both in terms of the entire swing and also in terms of the single candle. We can see that price is breaking with very strong green bluish colors. Okay, so that was definitely intention to go upwards. Now, using these tools, actually we can have different evidences, because, for example, we can see that price then came back here, pulling back all of these previous, which is already qualified as a demand area. Ideally, it just bounced from the midpoint of this range. In the next webinars, we will see why that particularly makes sense. But apart from this, we can see that in terms of volume, we had 24K pushing here to the downside, 20K here, and eventually 18K, roughly 80. So sorry, 60, more or less, in the overall. When we had the strong push to the upside, to the downside here, pulling back all of the area, is it stronger or weaker? In terms of volume, it is definitely stronger. Not that much away, not that much different from the swing which was trying to break the high. So that means that ideally, yeah, price could pull back and respect the previous demand area actually, but this isn't ideally what in terms of volume I would like to see. Because once we had this situation established, ideally I should consider this area, the previous demand area, as a buffer zone. A zone where price should ideally just touch lightly with low volume before continuing to the upside. ideally I shouldn't be seeing too much volume going on here, because that would mean that be in trying to whilst trying to re-enter in the area, there is still acceptance, which, which there shouldn't be, because we already have traded this area. If the demand force is still in play, there shouldn't be a further fight in order to determine a continuation of that strength, which has already won once. So this is the first warning sign. Then what happens? Market tries to, it bounces actually, and it tries to make a new low. So it gives us another upswing with way less volume than the previous attempt. No effort. Market is just not pushing as it should be, as ideally should be if demand is still in play. That was the first warning light. That's the second warning light. That doesn't mean, of course, I can't use this situation to establish a long scenario anyway. But after looking at this and putting the two informations together in combination, of course, I have two clues of weakness, and therefore I have to make my trading decisions according to these informations. Either I am already in the trade, either I am looking for a trade, so I'm still flat. If, for instance, I would decide anyway to enter long here on the pullback on the previous demand area, just as an example, after looking at that, it doesn't even make it to make a double high, double top. I need to at least protect my trade, because I can spot weakness in real time. Also, this information is available from that previous swing to the high, second swing to the high, which is way lower in terms of volume, in terms of participation, even if delta is quite the same. Delta, I would say, it is maybe slightly stronger than in the previous swing. Slightly. But still, volume, delta can't anything without volume. On the other side, let's go for other examples. We can also see that after on the high, commitment goes always decreases, sorry, even more. 27, 15, price is starting to make lower lows. But in this case, we don't even have evidences of buyers taking control. Sorry, sellers taking control. It never happens. So ideally, that's an area where to stay flat because we don't have any evidence given by volume. But here, of course, we had. Here we had an evidence of first victory of buyers. Here we had the chance of a pullback with too much participation. Yes, we shouldn't be looking at the ideal condition in order to spot a continuation would be ideally half of the volume here. So if we had 60K participating here, the pullback ideally should be 30K, 35, 40, no more than that. When we have such a high volume, it can easily mean two things. There is too much participation, as we said. So either we have still many sellers participating, which it is, because if we had so much volume, that means that both buyers and seller were transacting and willing to transact. So there's still a matter of acceptance. The higher the volume, the more acceptance we have. If we want to think of that in a more advanced way, if there are so many sellers, will they fail or will they make it? That's another story. That's another story we will be talking about over the next webinars we have, because of course this is something much more complex and with coming with many different variables. But from a simple perspective, if we want to keep that simple, the ideal pullback once a supply or a demand area has been established should be with less volume, at least roughly 50% of the volume we had on the previous attempt of trading that area. After, of course, determining that the break was caused by a relevant part of volume and the entire swing breaking out the high or the low was actually supported, sustained by volume. And if you want to add this further information in your analysis, also delta, which you can easily see from the colors shading of the bars here, or either from this tool with the setting showing delta and delta strength inside each rectangle showing the swing. Okay, guys, I think we have gone through the topic entirely. Uh, if you want, we can have a look at different examples, unless you have some questions. I will be glad to answer them. Just reading the first one. Um, yes, actually, Raffaele, yeah, there is a registration, a recording of the every single meeting will be recorded. I guess you can check on uh, the Trading Pit website if there is a. To be honest, I don't know either where every recording can be seen, but ideally I guess there should be or either on the YouTube channel, or otherwise next time I will ask for you and I'll let you know on next webinar. I will definitely ask because I'm curious to rewatch, even if it's me, but rewatch what I've talked about. Oh, okay, great. There is the link here. Thank you. Thank you, Giuseppe. Um, can I use this also with regular candlesticks? Yes, of course. Of course. Let's get a quick example from using this setting. Um, let's set it at maybe 5 minutes. Okay. That's the very same example on a 5 minutes chart. Let's just make it more visible. Okay. Same thing as we said, as we can see, we have the zigzag identifying the swing to the upside or to the downside and representing actually visually the volume and the inside delta, uh, as well as the information in terms of numbers at the top of at the top of a downswing or at the bottom or of an upswing. Okay, of course, in terms of looking at a 5 minute chart, you need to, yeah, follow the same in order to conduct a proper analysis. You need to follow the same rules, if you want to put it this way, than range bar. So you need the range, you need the break of that range, and since the zigzag works in terms of uh, tick reversal from the absolute high and the absolute low, you might need to adjust the settings because this is 10 ticks from the high or from the low. It might not be the perfect settings with a 5 minute chart. So you need to find the proper setting according to the uh, time frame you will be using in order to have the swing starting from the low. Okay, so in most of the cases, here it works fine, here it works fine, here it works fine, but for example, here, yeah, that's the one I was looking at earlier. Here you have a retracement, an internal retracement within this downswing, which it isn't included in the zigzag because of course it was too small to trigger the reversal parameter. So it might need that parameter might might need to be adjusted. Okay, but yeah, of course you can use it with whatever time frame and whatever type of time frame. Of course, yeah, this is important. The thing of the color code inside the bars, same thing. Whether we see a very nice delta coloring inside the bar breaking out a high or a low, that would definitely confirm. Maybe in this case, since a minute bar will also show the increase of volatility just looking at the range of the bar, maybe it will be slightly helpful in this case as opposed to range bars, as you have all of the delta calculated within the same bar, within just one single bar, and not maybe two or three going one each other. Okay. Cool. I think we can end here for tonight. Hopefully everything was clear. Of course, for whatever question, just ask me, please. Or those are concepts that we are gonna repeat time after time, though. So because actually every single webinar is like an episode of of the series. So what we will have to what we said today is gonna prepare for further application we will talk about next time. So in somehow we will be repeating and resuming what we said in the last episode. Okay, so there will still be the chance to actually recap different aspects we have talked about. Okay, cool. So, hope you enjoyed tonight. We are gonna meet for the next webinar next Wednesday, still same time, and we will start talking about the most important volume profiling tool, which are volume profile and TPO, also known as market profile. Uh, that will be very interesting in terms of market structure. So those are information getting very well along with um, the introduction we've made last time and the supply and demand area we've talked about tonight. So see you next week. Enjoy your evening, and have a nice day.